Here we go. Welcome to the show, Raj. How does it feel to be Raj today?
I'm feeling great today. Thanks for letting me in, Brett.
Tell us a little bit about your medical journey, where you started and where you're at now.
I actually live in Houston. I'm a pediatric oncologist, a children's cancer doctor. I trained originally in India, and then I trained in UK, in London, and then Peoria, Illinois, Los Angeles. Now I'm ended up in Houston. I feel very fortunate to be a children's cancer doctor, and the majority of my time I do research, trying to do clinical trials for new medications for cancer. And then, of course, on the side, I'm also a real estate investor. My story is, of course, I already told you, I'm a researcher, cancer researcher. The most of my life, I was involved in like publishing, finding new things, and those kinds of things. And as a doctor, your career is very set, right? So you, especially an academic doctor, you go and start as an assistant, professor, associate, become a professor, which I did. And then at some point you look back and say, hey, I've done everything right in my life. I'm not a big spender. I save most of the money I earn. And then I went back and looked at it and said, maybe I should be having more money in my retirement account at this point of time than what I'm having. What just happened? Because I'm not a lavish spender and those kinds of, then I started thinking about why is it not happening? I've been saving. Everyone teaches you save, save, save. That's what you need to do. And then, of course, I put it in my 401k, the market and everything. So that's when I started thinking about, hey, there's something not right or something different I have to do. So that's when I started looking into real estate. Because when I first started, I started as a passive investor. I saw an ad for a syndication. I didn't even know what a syndication was, registered syndication. Then I went and invested that. This was back in 2017. And then I've been investing every year, seeing what happens and learn more about it. And then I thought, more doctors should know about this type of investment. Of course, I never tell physicians, don't invest in stock market or don't do this thing. But everyone should have, as part of their diversified portfolio, some investment in real estate. So that's why I started this company, to help other physicians invest in pre-scrutinized investment opportunities, which I invest myself. And then I take to them and say, hey, this is a really good opportunity. Do you want to invest? So that's how this company started.
But I think it's a great way. If you're starting with the single family, it's a great way. It's a lower barrier of entry. When we're talking about being somewhat active, it's just a great place. And mistakes are, I have a hard time saying this, but mistakes are a little easier to overcome on the smaller end, on the single family residential, than when you step into the commercial side, when you're scaling. Because when you scale responsibility, you scale returns, hopefully, but you also scale losses if you were in that scenario, right, Raj?
It's important to partner with the right people, right? So the partner with people who have done this in the past, not go with someone who hasn't done it at all, right? So they have gone through multiple cycles, those kinds of things. So when I think about single family, of course, I had experiences. The stress level for me is the same, whether it's single family or multifamily. So if I have one tenant in a property and then they don't pay rent or they destroy the place before they leave. So I have gone through all those scenarios. And then if you don't have cash flow from that one property, then your entire years of income is lost from that property, and you're often putting money out of your pocket into that property. When you go to the multifamily, when you have 100 units, even if 5 units don't pay rent, you're still able to generate the cash flow. So those are the things. There is some risk reduction when you scale. Of course, if you don't have the right team, we don't do things like deep value add, which are higher risk. So we always go for properties you're already cash flowing at the time we buy. So that the risks are reduced. And typically my investors who come in, the physician, my colleagues, they are okay with having a lower return for a lower risk. So that's the kind of property we go for: Class A, Class B, already cash flowing, those kinds of properties. We generally don't go for deep value add.
Raj, the OMs, offer memorandums, there's so much of that, that is fluff. It's not, let's get real. There's so much fluff that goes into operating memorandums, which is, it's good. You're in the area. Yeah, you understand these things. But when it comes down to it, how's the asset performing? What's the history of the asset? What's the history of the operator?
Yeah, exactly. I'll tell you the example. We actually wanted to do a JV on a property here in Houston near downtown. It was a 20 unit. And then the pro forma said, hey, this is what we're projecting, 160,000 NOI per year. And then I said, okay, I agree. Give me the T12 and your actual transactions. And it turned out to be 106,000 per year.
Wow.
Right. The value there, so they're asking 2.6 million. Now the value suddenly dropped down to $2 million, right? It's a big difference based on the NOI. So yeah, so you have to be careful looking at the pro forma, because the pro forma is prepared by the broker on a rosy scenario in future. But we have to ask the question, if they're so rosy, first thing is, why are they selling in the first place? And why haven't they achieved the same thing right now? What's preventing them from achieving their NOI right now? So there should always be, there usually is an underlying issue why it's not happening. So we have to find the exact reason before we offer the purchase price.
Where do you see the current market now? And then what's it going to look like in 12 months?
So people have been predicting that at this time, right, towards the beginning of the year, they said, hey, you're going to get good deals end of the year, just wait. So far, it hasn't happened, at least the way I see it. Of course, there are some distressed deals out there which have to sell, but the people who don't have to sell they're putting on the market, they're still expecting a lot higher than based on the interest rate, insurance rate, whatever it is. They're still stuck in last year's prices. It's very difficult for a seller who could have sold last year and got like many hundred thousands more to decrease the price enough for us to buy. So we have been constantly looking to say, hey, is there any deal? None of them, actually, to be honest, at least in Houston where I live, none of them cash flow, even in the smaller multifamilies. So we are not pulling the trigger for those things. Of course, there are some distressed deals out there which may make sense. But as long as the actual insurance rate or expenses don't bother me, the interest rate, as long as we put in that thing in the underwriting, right? If you underwrite for 8%, if you underwrite for $1,000 per unit for insurance, and if you can still make the deal work, then there should not be a problem. But right now it's not happening. So that's why we are on the sidelines most of the time trying to find a new deal.
What would you tell somebody who is just starting, a physician out there listening today who hears other physicians talking about syndications, talking about multifamily, want to get into being a limited partner? Where do you suggest they start? So
for physicians, first thing is there are a lot of options out there. So get to talk to different sponsors. Sponsors are people who are actually actively doing syndication, and then see who you actually connect with the best, right? Their values, the way they explain things, the way, are they promising too much, those kinds of things. You have to always talk to people. In some ways, this is a trust-based industry rather than the numbers. You can talk about numbers all the time and you can look at the numbers, but when you're just starting out, as I said, you may not know what they're projecting, whether it's true or not. So always talk to different sponsors, see who you connect with, trust it, and then start with small, like $50,000 investment, and then start learning about the industry.